Here's a typical example of a manufacturing firm's balance sheet. You'll notice assets on the left, liabilities and equity on the right. Very common presentation. You'll notice that under the asset column on the left, you've got current and you've got long-term. Current assets, in this particular example, are made up of cash, accounts receivable, inventory, and other. Cash is exactly what it says. What do we have in our accounts in the bank? Accounts receivable, and here's a link to the income statement. Accounts receivable, if you remember, are the sales that we have made that we have yet to collect. The only way we could see accounts receivable on the balance sheet is if they're using accrual accounting. So that's a little hint right away. So if we have cash, accounts receivable, then we have inventory. Inventory may be raw material, work in process, or finished goods. In this particular presentation, it's not broken down. We might need to dive a little deeper. If we are going to the bank to secure a loan, the bank probably wants to know what proportion of our inventory is in each of the three phases, because as collateral, it does make a difference. We'll talk more about this later. In this particular presentation, the fourth example is other. Other could refer to insurance that is prepaid or any asset we're going to use the value of in the next year. But here's an important point. If you look at this, you may notice that there's a consistent ranking of everything on the balance sheet. Even within the subcategories, current assets are listed in a specific order: cash, receivables, inventory, other. Is there a reason for this? Of course there is. Assets are listed in order of liquidity. In other words, by accounting rule, we list our assets in the order of how quickly, in the normal course of business, they'll turn into cash. So obviously, cash is the first entry. We collect our accounts receivable that eventually turn into cash. That's why those are second. Inventory has to be finished. If it isn't finished goods when we start, then it has to be sold to turn into receivables, then it has to be collected to turn into cash. So you can see the logic there. So then we total those for our total current assets. Under our long-term assets, machinery and equipment could be converted into cash more quickly than buildings can, assuming we were going to do that, and land, which never disappears, is always listed last. So now we have long-term assets. Subtotal B, our total assets are all of our current assets plus all of our long-term assets. Now, admittedly, the balance sheet is focused on a product-based company. There wouldn't be many differences if we're a service-based organization or a not-for-profit. The logic is the same. Another important point for those looking at this, wondering why we don't break inventory down into more detail. Accounting doesn't tell us the level of detail for our financial statements. It lays out the basic requirements. The level of detail we choose to present on our financial statements is partially determined by us and partially determined by requirements of lenders and shareholders. So that's why this example is perfectly fine. You may want to have more detail. So if we go from the asset side to the liability side, we have current liabilities separated from long-term. Again, the current liabilities are listed in the order in which they're normally going to be paid off. Accounts payable, what we owe our vendors. Probably pay them off in each period and recreate them. Notes payable, if we have those, are a series of installment payments to all be paid within the current period. The next one, I just love this. CPLTD, which represents current portion long-term debt. It's a way to look below, look at the long-term debt. So this could be a mortgage or the financing of a major piece of equipment over multiple years, less CP, less the current portion. So if we owe $5 million over the next 10 years, we're going to pay $500,000 per year. Under long-term liabilities, we'll show the $5 million less the $500,000, which then moves up to the current portion of long-term debt. So the liability section is as revealing as is the asset section. What do we owe when? We've got our subtotal C of our current liabilities. We look at our long-term liabilities. We've already addressed the first one. If we have capital leases, which is renting an asset for a very long period of time, as if we owned it, and there are different criteria we will look at later. If we have capital leases, they're normally listed after our long-term debt because that's the most traditional form of debt. And then if we have corporate bonds, long-term, unsecured corporate borrowing, they would be listed third. Those are the three most common forms of long-term debt. There's our subtotal D. Then we look at our equity section, as we did a moment ago. Common stock is what we sold to start the entity. Retained earnings is the accumulation of all the previous year's profits, less the cash dividends we paid out at the time. So we add up C, D, and E. Total liabilities and equity must equal total assets. If they do, the balance sheet is in balance. Exactly what we want to see. Now, when we talk about bookending the financial year, we typically have an opening balance sheet, as we said at the beginning of the year. That gives us our baseline or our starting point. At the end of the year, we'll have a closing balance sheet. One way to judge how well an organization is doing is to start by looking at the two financial statements, the two balance sheets. What did the organization have in the way of assets, liabilities, and equity to start the year? What does the organization have for those same categories at the end? That'll give us the difference. It'll tell us, did assets increase, stay the same, or decrease? Same thing with liabilities and equity. And is that consistent with what the organization projected? We also will find that as we get into the cash flow statement, you'll see how the cash flow statement is linked back to the balance sheet. So we know that the cash entry is correct. Now, when we compare current versus long-term, we've covered some of this already. The specific accounting guideline is assets that we're going to use up within the next 12 months or operating cycle is the requirement. Well, for the vast majority of organizations, those are the same thing. But in one or two industries, the operating cycle is greater than a year. That's when there's an exception made if that is standard in that industry. Again, there's very few industries that meet that. Most current assets are used up and replaced in the normal course of business multiple times during the year. And we'll actually calculate how many times per year we expect cash, receivables, inventory, payables to turn over compared to how many times per year they actually do, as a way to assess whether the organization is being run properly or not. The final point here is something we mentioned earlier, but it is critical. The current assets must be listed in the order of liquidity, how quickly they're going to be turned into cash. It's consistent when we move from assets to liabilities. Again, the liabilities, when we talk about current liabilities, those are going to be paid by agreement, the normal course of business, within the next 12 months or operating cycle. Again, they're listed in the order of expected payment. Accounts payables are always listed first because, again, those are our obligations to our immediate suppliers that normally we're paying in the typical course of business on a regular basis. Monthly is very common, and being replaced. Accruals, which we'll touch on in just a moment, are frequently listed next if we don't have notes payable, and then our current portion of long-term debt or anything else. Moving from the current to the long-term are also known as fixed or non-current. So you probably have noticed already, both in the first module and in this module, that accounting has a tendency to give the same item multiple names. It is common, it is the nature of accounting. There's been a lot of conversation about standardizing all the names, so long-term is only called one thing, or the income statement is only called the income statement. That argument's been going on for decades and probably will continue. So we just need to make you aware of the fact that whenever someone is using long-term or fixed or non-current, they're referring to the exact same thing. On the asset side, long-term assets are normally listed in the order of what accounting considers their useful life. Now, an accounting useful life and a practical useful life sometimes are very different. The useful life of most equipment is 15 years. That does not mean we only can use it for 15 years. That has to do with the accounting calculations of how long we are allowed to recover the cost using depreciation. And we'll cover this soon. The long-term assets, again, are reduced in each period by the non-cash deductions. And we'll talk about the three forms of non-cash deductions subsequently, so you can tie it back in here and go through the calculations. Same thing with the liabilities. The liabilities are listed in the order in which they're going to be paid off. They are typically, again, we've got bank debt. Corporate bonds would come last if we have those. Capital leases would come in between if we have those. And again, the reason is bank debt is usually shorter term to be paid in full than our capital leases. And capital leases frequently are paid off by contract sooner than corporate bonds are. There's the logic. So if we look at an example of a balance sheet, this is an actual company. You'll see there's a little more detail here than we covered because we wanted to go through the basic categories. If you just look at current assets, in addition to cash, we have short-term investments. Short-term investments like certificates of deposit or time deposits or repurchase agreements meet three criteria: virtually no risk, highly liquid, can be converted back into cash in 1 day or less. So that's not where we speculate. You'll notice also under the current assets, below that, when we get into our longer term assets, property, plant, and equipment. Look at the next line, less accumulated depreciation. This is the accounting way to reduce the value, to recapture that investment over its accounting useful life. And we'll go through some specific examples of this later on in subsequent modules. We look at our liabilities, accounts payable, short-term debt. There's your current portion of long-term, etc. So this organization has chosen to present their balance sheet with more detail than the previous version we looked at. Unless it's required by a lender or investor, that's an organization's choice.